With December 31st just around the corner, there's a small critical window where the moves you make can directly shape how much tax you'll pay in 2025. And here's the catch. Most people either wait too long or make one small mistake, like falling into the superficial loss trap or pulling TFSA money in January instead of December, that ends up costing them thousands. The year-end deadlines are real, and if you miss them, you don't get a do-over. In this video, I'll walk you through the key year-end strategies every Canadian should know, whether you're still growing your savings, already drawing from your RRSP, or somewhere in between. We'll cover how to harvest investment losses properly, the timing rules that can make or break your TFSA, why opening an FHSA now matters, even if you're not house hunting yet, the new home buyers plan rules, spousal RRSP timing tricks, and a handful of family, employee, and incorporated owner checklists that can mean real money in your pocket. Think of it as your clear, plain English roadmap to the high impact year-end moves that still matter before the clock runs out. If you're new here, welcome. I'm Jacqueline Ozdemir, a financial advisor with the Ferguson Financial Planning Team. I spend my days helping Canadians make sense of the moving parts in their financial lives, figuring out when to take action, how to avoid unnecessary tax bills, and how to fit all the pieces together so their money actually works the way they want it to. Over the years, I've seen so many people miss easy wins simply because no one explained the rules in plain English. My job is to change that, and in today's video, I'm going to cover the highest impact year-end strategies to help you lower tax and strengthen your financial plan heading into next year. We'll touch on smart ways to use capital losses, why the timing of your TFSA withdrawals actually matters, how an FHSA open before year-end can set you up for more room later, important updates to the home buyers plan, RRSP strategies that pay off faster, the value of creating pension splittable income at age 65, and finally, some quick year-end checklists for families, employees, and incorporated Canadians. If you find this video helpful, please be sure to give it a like, drop any questions in the comments, and hit subscribe with the notifications turned on so you don't miss future tips. All right, let's dive in. Let's start with one of the most powerful year-end moves that doesn't always get the attention it deserves: harvesting capital losses. This is something that can literally mean the difference between paying thousands more in tax this year or not. Here's the deal. When you sell an investment for less than what you paid, that's a capital loss. You might think of it as a bad trade, but the tax rules actually allow you to turn that loss into a bit of an asset. You can use those losses to reduce capital gains you realize this year, and if you don't need them right now, you can even carry them back up to 3 years or carry them forward indefinitely. For 2025, Canada is still using the 1/2 inclusion rate on capital gains. The play here is timing. Realize losses in December to offset gains this year or carry them back up to 3 years or forward for future use. Let's make this real with Nina and Mark. They sold a business earlier this year and realized significant capital gains in their non-registered portfolio. Since 1/2 of capital gains are taxable, those gains push their taxable income higher than expected and set up a bigger tax bill for April. What did they do? They looked through their portfolio, found some underwater positions, stocks they bought higher but were losing money on, and sold them before December 31st. Those realized losses went against their gains, reducing their net taxable capital gains for the year. In practical terms, the loss on paper saved them tens of thousands of dollars in taxes. Now here's the trap: the superficial loss rule. If you, your spouse, or a company you control buys the identical security within 30 days before or after your sale, the CRA will deny the loss. No write-off, no benefit. To avoid that, Nina and Mark picked a similar but not identical investment, giving the portfolio exposure while keeping their loss valid. So what's the takeaway here? Don't sit on big losses if you already know you'll face a steep tax hit from other capital gains. Time your trades before year end, keep an eye on that 30-day window, and coordinate with your spouse's accounts so you don't trigger an affiliated person purchase by accident and a superficial loss rule. Getting this right doesn't just feel smart, it can swing the bottom line in a very meaningful way. The TFSA is one of Canada's favorite saving tools, but the timing of your moves matters more than most people think. A quick decision in December could give you thousands more in room come January. Here's why. Any money you withdraw from your TFSA doesn't free up that contribution room until the following calendar year. So if you know you'll need $5,000 early in 2026 for, say, a home renovation or a big purchase, it may make sense to withdraw the money in December this year. That way you don't lock yourself out of recontributing. Come January 1st, that withdrawal amount automatically gets added back to your contribution room. So let's bring this to life. Say Rachel wants to tap $10,000 in the spring for her daughter's tuition. If she pulls the money on January 2nd of 2026, yes, she'll have it, but that $10,000 of room won't return until 2027. That's a lost opportunity to shelter her money for a full year. If she pulls it out in late December instead, the $10,000 of space is back in play right away on January 1st. She can contribute again as soon as she has the funds, even the same $10,000 plus the new $7,000 TFSA limit for 2026. That's a $17,000 swing just because of timing. Another angle here is charitable giving. If you have shares sitting on a gain in your non-registered account, donating them directly to a registered charity not only gives you a receipt for the full fair value, but you also avoid capital gains tax entirely. It's a double advantage: tax deduction and no gain. Some people even use their TFSA withdrawals for the cash flow, then replace it in January with a new contribution room. So the lesson is this: don't treat your TFSA like a one-way piggy bank. It's a tool with year-over-year carry rules, and if you play those rules smartly in December, January magically becomes more flexible. The first-time home savings account is still relatively new, and there are lots of people sitting on the sidelines thinking, well, I'm not buying anytime soon, so what's the rush? Actually, there is one. By opening the account before December 31st, you activate carry forward room for the next year, even if you put in $0 today or in December. Here's how it works. The FHSA gives you $8,000 per year in contribution space to a max of $40,000 over your lifetime. Let's say you're eligible, but you don't open the account in 2025. When 2026 arrives, you can only put in $8,000. But if you open it now in 2025, even with no deposit, you'll be able to contribute $16,000 in 2026. That year's 8 plus the unused 8 from this year. That's like buying yourself more tax-sheltered space with just a signature on an application form. Look at Jay's story. Jay plans to buy his first home in the next few years, but not right away. In December, he opened an FHSA with no deposit at all. Come January, he had $16,000 of space available. By contributing then, he knocked down his 2026 taxable income by the same amount, $16,000. Because remember, FHSA contributions are deductible like RRSPs. That put more money back in his pocket at tax time and set him up with an account that can later feed either his down payment, or if buying doesn't pan out, be rolled tax-free into his RRSP or RIF. What's powerful here is flexibility. If Jay never uses it to buy, nothing's wasted. The funds can transfer to retirement savings. If he does buy within the next 15 years, the withdrawals are tax-free like a TFSA. You rarely get a tool in finance that has 2 safety nets, but the FHSA is one of them. And the only catch is timing. If you don't open before year end, you miss out on banking the extra space earlier on. So if you're eligible, even if you just ink the paperwork with $0 this December, you're doing your future self a pretty big favor. RRSPs aren't just about how much you contribute, they're about when. That's especially true if you're maximizing strategies with a spouse. Here's where it gets interesting. With a spousal RSP, contributions made by the higher income partner go into account under the lower income spouse's name. Later, when withdrawals happen, the tax can be at their lower rate. But CRA has a rule. If withdrawals happen within 3 calendar years of your last contribution, the income gets attributed back to the higher income earner. Translation, the tax benefit disappears. Now here's the trick. Those 3 years are calendar years, not 365-day periods. So if you contribute in December 2025, the clock starts ticking. By January 1st of 2028, withdrawals can be made at the lower income spouse's rate. That's why a December deposit can be more powerful than one in January. You start the clock sooner. Let's use Paige and Dan. Dan is turning 65 next year and will retire. Paige has a spousal RSP. By contributing in December 2025, they've started the 3-year attribution countdown a whole year earlier. So when Dan needs income in 2028, it won't bounce back to him at his higher rate. Not only that, but because he's 65, he can set up a RIF and generate a few $1,000s of eligible pension income to split with Paige and also claim the pension credit. That's coordinated retirement planning, and it saves thousands in taxes over time. Another timing tip: if someone dies in 2025 with RRSP deduction room left, a contribution to their spouse's spousal RSP made by March 2nd, 2026 can still be claimed on the deceased's final return up to the remaining deduction limit. And if you're turning 71 this year, your last day to contribute to your own RSP is December 31st. So the key with RSPs isn't just max it out. It's about thinking like a chess player. Each contribution sets up a future move, and December is where the timing can swing in your favor. The home buyer's plan has been around for years, but 2024 brought some big upgrades. The maximum you can now withdraw from your RRSP to buy a first-time home is $60,000, up from $35,000. On top of that, that, Ottawa extended the grace period for repayments to 5 years if you made your withdrawal between January 1st, 2022 and December 31st of 2025. On paper, that's great. More access to your savings at a time when home prices are sky high. But the smart play is knowing how and when to use the new rules. Jay, again, is a good example. He was planning to withdraw money in December 2025, but decided to wait until January. Why? Because waiting gives him a full extra year of grace period before repayments start. That's cash flow breathing room right when he needs it most during the years of heavy mortgage payments. At the time of filming this in October 2025, the start of the repayment period was temporarily increased from 2 years to 5 years. Therefore, I encourage you to check current rules on the CRA website on the timing of when you need to start your repayments if you plan to withdraw from your home buyer's plan in 2026 or later. And here's another quirk. You choose each year whether to designate RSP contributions as your home buyer's plan repayment. If you don't designate the minimum, that amount is simply added to your income. That can actually be smart in a low income year. Say you're between jobs. Well, you still make an RSP contribution by the beginning of March and claim the full deduction. Counterintuitive, but for some households, it's the smarter play. Bottom line, the home buyer's plan isn't just about rating your RSP to get a new house. With the new $60,000 limit and repayment extension, it's more flexible than before, but only if you understand the timing levers. Now, let's talk about families. These are the kinds of small moves that can cost you free money if you forget about them. The RESP, Registered Education Savings Plan, is a big one. To earn the full $500 Canada Education Savings Grant, you need to contribute $2,500 per child before December 31st. If you have carry forward room, you can contribute up to $5,000 and capture up to $1,000 in grant money. If you miss the calendar year, it's gone. You can't double back for it later. Take Sarah and Lee. They have 2 kids. They were behind, but in December, they contributed $5,000 total. That gave them $1,000 in grants right away. If they'd waited until January, they'd have left half of that free money inaccessible until a later year. Another family-focused rule is the prescribed rate loan strategy. Some couples use a simple loan structure to split investment income between spouses. The rule says that the borrower spouse has to pay annual interest at CRA's low prescribed rate by January 30th. If you skip that, the whole income splitting strategy unravels and all income is taxed back to the lender. Paying that interest is a small check that saves big money. There are even day-to-day things like cash flow priorities. If your taxable income is lower this year than usual, you might not need to make a December 15th tax installment if you're otherwise paying these. Or if you're carrying non-deductible debt, like a personal line of credit for renovation, any spare cash should pay that down before the year ends. Family strategies are always a mix of small and big moves, but the lesson is simple. Deadlines matter. Miss them, you lose government grants or tax efficiencies forever. Finally, let's cover some quick don't miss items for people employed with benefits or running incorporated businesses. If you have a company car, the taxable benefit is based partly on how many days it's available to you. If there's a chance you won't need it for the rest of December, handing it back even a few weeks early reduces the benefit. Also, if you pay your employer back for operating costs within 45 days after year end, typically by February 14th, you can cut down the taxable amount reported on your T4. Small timing, real savings. For employees with low interest or interest-free company loans, another deadline looms. Pay the interest for the year by January 30th of the following year, for 2025 by January 30th, 2026. This preserves the favorable loan treatment and avoids having that benefit grossed up as additional taxable income. For incorporated owners, year-end planning carries even more weight. If you bought eligible private company investments that failed, you might qualify for an allowable business investment loss, ABIL, which is deductible against all sources of income. For 2025, the allowable portion equals 1/2 of the loss, or if you've drawn money personally out of the company as a shareholder loan, make sure it's repaid within 1 year after the corporation's year end to avoid it being included in your income under the shareholder loan rules. And something as simple as transferring a depreciated company vehicle into your personal hands before year end could reduce both your future benefits and shuffle some taxable advantage into the right year. Case in point, Alex, an incorporated professional, was being dinged each year with a huge standby charge on the original high sticker price of his company car. By buying the vehicle personally before year end at its much lower depreciated value, he stopped the annual tax bleed and even lined up a deduction for his corporation. At the same time, he assessed whether a failed private company investment could qualify as an ABIL, softening the blow of that loss with real tax relief. These aren't glamorous moves, but they're the difference between leaving money on the table or not. And once the year closes, you can't go back. So when we step back, here's the bigger picture. Year end is a closing window. It's a set of deadlines that, if handled thoughtfully, can shift thousands of dollars in your favor. Harvest your losses with care, time your TFSA withdrawals the smart way, open or at least activate your FHSA, play the calendar year rules on RRSPs, know the new breathing room on the home buyer's plan, grab free money for your kids' education, and tidy up the small details in your employee or corporate life. At the end of the day, taxes are your single biggest recurring expense. And the truth is, no one sends a reminder telling you which doors close on December 31st. That's why planning now is about stacking easy wins before they disappear. So let's tie this all together. Every move we just covered, whether it's realizing a capital loss before the clock strikes midnight, pulling from your TFSA in December instead of January, or locking in that FHSA contribution room early, comes down to one thing: timing. And that timing can mean thousands of dollars either working for you or quietly slipping away to taxes. Think about it this way. Nina and Mark avoided a larger tax bill just by realizing losses at the right moment. Rachel freed up $17,000 of TFSA space simply by withdrawing a few weeks earlier. Paige and Dan saved future retirement income from being taxed at the wrong rate by contributing in December instead of January. Small shifts, sure, but together they add up to major advantages. The implication is pretty clear. If you do nothing, it's not neutral. It can actually cost you. But when you act with intention before year end, you're not just following rules, you're shaping the rules to fit your plan. And that's the real win here. Planning doesn't have to be complicated. It just has to be timely. And that's the heart of it, timing. When you stack these little year-end moves together, the difference is measured in thousands, not hundreds. The window is short, but the impact can last for years. Now, I'd love to hear from you. Which of these strategies do you think makes the biggest impact for your own situation? Is it the tax loss harvesting, the TFSA timing, or something else entirely? Drop your thoughts in the comments. I'll be watching and answering questions there. And if you're wondering how these ideas could apply directly to you, that's exactly what I do with clients every day. You don't need to guess. Click the link below, book a discovery call, and let's map out how these year-end strategies fit your life. If this video gave you something useful, give it a thumbs up and hit subscribe with the little bell icon so you never miss the next strategy we share. Thanks for watching. Enjoy the rest of your day, and I'll see you in the next video.